Hi, this is Larry Lane from InvestorZoo.com, and today we're going to talk about mutual funds. So the chief reason to purchase a mutual fund is for diversification. A mutual fund may hold as little as 20 stocks, bonds, or commodities, you name it. There's pretty much a sector of the market that you can invest in mutual funds. If you have assets under $50,000 to invest, mutual funds are an ideal vehicle, mainly for diversification purposes. By investing in a mutual fund, you are in fact becoming a shareholder of stock within that mutual fund company. Mutual fund company may have the ability to meet with the CEO, board of directors, have the opportunity to tour plants and get really deep inside the company before they invest, and that's something that certainly you or I as a private individual don't have the ability to do. However, there are some pitfalls to mutual fund investing. Your mutual fund manager is bound to invest by the fund's prospectus. So if they want to invest in a tobacco company, as long as it fits within the guidelines, you don't have any recourse if you find it objectionable. With your when you buy a mutual fund, your money is pooled with other investors. So money may pour into a hot mutual fund, and this may cause the manager to invest stocks outside the fund's initial prospectus. They can always rewrite the prospectus at any time. So this is called sector drift. So if you initially had bought into a mid-cap company, a mid-cap mutual fund, and that mutual fund just took off the previous year, and that fund is now seeing huge inflows of capital, the mutual fund company may have to start to add in some large cap stocks because they have extra money to invest. This is generally the reason that a hot fund may lag the market next year. There's a lot of uncertainty that your mutual fund manager has to deal with such an inflows of capital to know what to do with the money, and as well as they have to deal with outflows. If there's a run on the mutual fund company on your particular fund and people are redeeming shares, your manager has to do the same thing to raise cash. They have to sell shares, and this can also put a drag on your fund's performance. So even though you don't want to sell, you're kind of at the mercy of some of the other shareholders within the mutual fund. This can also put a ding in your total return for the year. Any profit that your mutual fund company shows for the year, as far as buying and selling shares, are passed on to shareholders. So even though you didn't redeem one share of stock, you will have taxes to pay at the end of the year based upon your fund's profit. So it's one of the big drawbacks. The other drawback, even if your fund didn't make a dime, if you had bought a mutual fund at $10, at the end of the year the fund ended up at $10 and you didn't see a gain, you're still going to have to pay taxes on any gain that the mutual fund had. Historically, most fund managers don't even beat their benchmark. Researchers at S&P did a study in 2006 and found out that only 38% of large cap managers managed to beat the S&P 500. Over a 5-year period, that drops to 33%, and small cap mutual funds, they did even worse. They lagged their benchmark by 24% over a 3-year period, and over a 3-year period, just 21% beat the corresponding index over a 5-year period. What that means to you: over a 5-year period of time, you stand a 67 to 79% chance of losing to an unmanaged index. Just because your fund is hot this year, or even for the last 5 years, it doesn't mean it's going to be hot for the next 5, the next 6 months, or the next year. Your fund companies just have too much to deal with. So let's go over the types of mutual fund shares. There are Class A shares. These are typically called loaded funds, and charge a percentage up front to invest. So this can range anywhere between 1 and 6% right off the top. So the second you put your money into your mutual fund, you're behind the eight ball already. You get into a loaded fund, you've got to make up for that initial expense. There's Class B shares. These are typically known as back-ended funds. And these funds charge a percentage when you sell your shares. Generally, after a given period of time, whether it be 3, 5, or 10 years, your Class B fund may waive that fee if you stick with your fund for however many years, but you have to check your fund's perspective because each fund is different. Investment management fees. This money goes to cover your the money to pay the management fees, advertising, and related salaries. Investment fees can vary from fund to fund. Knowing your fund's expense ratio is extremely important. The average fund expense for a mutual fund is about 1.5%. So what this means to you is every $10,000 that you invest, $150 is being deducted for expenses. And this is regardless of how well your mutual fund does, whether it doubles or whether it loses 20 or 30% for the next 3 years. They're still getting their money. If you think that fund expenses aren't important, just consider this fact. $100,000 invested over a 25-year period will turn into $684,000 if you retrieve an 8% return. If you squeeze out another 2%, you'll have $1.1 million. It's a difference of $415,000. So choosing the right mutual fund with the least expense, one of the most important things you can do before you even think about investing is to check the expenses for your mutual fund. So this is Larry Lane with InvestorsZoo.com. As always, do your due diligence. Check with your financial provider before investing a dime. Have a great rest of the day. And if you'd like to check out more blogs or post one of your own to our community, you can reach us at InvestorsZoo.com. Thanks. Have a great day.